I need you to lock in, completely lock in for the next few minutes, because what I'm about to lay out isn't some maybe scenario. It isn't an internet conspiracy thread, and it isn't fear-mongering for clicks. It is a mathematical certainty, a repeating mechanism that is already moving underneath your feet right now on this day, February 23rd, 2026. We are watching a slow-motion car crash involving over 127 million Americans who are currently on a track where they could watch their life savings, their retirement plans, and their safe money get chewed up in slow motion until one day it stops being slow. If that sounds dramatic, look at the data. We're sitting on a national debt pile that has ballooned past $42 trillion as of this morning, with interest payments alone now surging beyond $1.3 trillion annually. That's more than we spend on national defense and healthcare combined. Think about that. We're shelling out more to service yesterday's mistakes than to protect our lives and our borders today. But here's the shocking alert that's keeping me up at night. The BRICS nations, Brazil, Russia, India, China, and South Africa, now expanded to include Saudi Arabia, Iran, Egypt, Ethiopia, and the UAE, are weaponizing gold-backed digital tokens to dismantle the dollar's grip on global finance. With their combined GDP now eclipsing $30 trillion, representing over 45% of the world's population and controlling 40% of global oil production, they're not just talking, they're executing a systematic exit from dollar hegemony. By anchoring these digital currencies to massive physical bullion reserves, China alone holds over 2,500 tons of gold, Russia close to 2,300 tons. These central banks are bypassing Western sanctions, evading liquidity traps, and forcing a global valuation reset that could render the fiat dollar obsolete in the emerging East-led economy. Imagine this. In 2025, BRICS trade in non-dollar currencies jumped 85% year over year. And now in 2026, their new gold-backed token system is projected to handle $5 trillion in annual transactions, siphoning away from the SWIFT network that the US has dominated for decades. Picture this nightmare unfolding. You've done everything right. Built an emergency fund, steered clear of wild crypto gambles, poured into your 401k, trusting that a dollar earned today would hold its value tomorrow. Now watch as your account balance stays the same, but the world reprices violently around it. Rent spikes 25% in major cities like New York and San Francisco. Food costs climb 18% amid supply chain disruptions from geopolitical tensions. Insurance premiums soar 35% due to climate-driven claims. Mortgage rates hover at 7 to 8%, eating into refis, and taxes inch up through hidden fees and inflation-linked brackets. Your safe money? It's yielding 4 to 5% in treasuries or CDs. But real inflation, shadow stats show it's closer to 9 to 12%, not the official 3 to 4%. Means you're losing ground every month. This isn't random. It's financial repression, the stealth tax governments use in stage 3 of a currency collapse. Smoother than outright default, but just as devastating. It's the slow boil that suddenly explodes when the thermodynamics hit critical mass. The urgency? We're not just dealing with US debt anymore. The BRICS bloc is accelerating the timeline. Their gold-backed tokens aren't pie in the sky. Russia's already piloting a digital ruble backed by gold. China's eCNY is integrating gold reserves for cross-border stability. And the bloc's new development bank is issuing bonds in these tokens, attracting $100 billion in investments from non-Western allies in the last quarter alone. Shocking stat. Global central bank gold purchases hit a record 1,200 tons in 2025, up 50% from 2024, with BRICS nations accounting for 70% of that. This isn't about friendship. It's about survival. Sanctions on Russia post-Ukraine froze $300 billion in assets. Now BRICS is building a parallel system where gold-backed digits let them trade oil, commodities, and tech without touching the dollar, slashing transaction costs by 30% and dodging U.S. Treasury oversight. Deep dive into the market concerned. Let's analyze the Forex and commodity charts right now. The dollar index has dipped below 95 for the first time since 2022, down 12% year to date as BRICS de-dollarization bites. It's exploding, hitting $2,800 per ounce this week, up 25% in 6 months as investors flee fiat volatility. Bitcoin and other cryptos are correlated, but gold-backed tokens add a layer of stability that's pulling institutional money. BlackRock and Vanguard have quietly allocated $50 billion to gold ETFs in 2025, signaling hedge funds see the dollar's reserve status crumbling. Concern over the market? Absolutely. U.S. Treasury yields on 10-year notes are at 4.8%, but with $42 trillion debt, every 1% rate hike adds $420 billion to annual interest costs. If BRICS tokens gain traction, expect a flood of dollars repatriating, spiking inflation to double digits and forcing the Fed into a corner. Hike rates and crash stocks. S&P 500 already wobbly at 5,200 after a 10% correction, or cut and hyperinflate. Either way, the middle class gets crushed. Retirement funds lose 20 to 30% real value overnight. This isn't isolated. It's a feedback loop of debt, currency, and eroding confidence. In this video, I'll walk you through the 4-stage collapse pattern that's repeated across empires without mercy. Then apply it to historical blow-ups like Rome, Weimar Germany, and Venezuela. You'll see the fingerprints all over our 2026 economy, especially with BRICS flipping the script. Finally, I'll connect it to why 127 million U.S. households are exposed, and what moves separate the wiped out from the winners who scoop up assets post-crash. But quick favor, my channel analytics showed too many ghosts watching without subscribing. If you're getting value from this breakdown, hit subscribe now. We're gunning for 100,000 subs by March 2026. Be part of the community. Also, join our members only for exclusive deep dives. A dedicated team crafts premium content on BRICS updates, gold strategies, and market alerts just for you. Click join or check the description. And if you've crushed it, flipped real estate, stacked gold, or built a side hustle, share your win in the comments. It inspires the squad. All right, let's dive in because another week brings everything's fine headlines while the math screams otherwise. Every major currency collapse follows this 4-stage rhythm, driven by incentives that push governments to print and people to panic. Stage 1, foundation. A currency earns trust, stable rules, expanding trade, safe savings. For the dollar, this was post-WW2, gold-linked until 1971, fueling decades of growth. But BRICS is rebuilding this stage for themselves, with gold-backed tokens restoring scarcity that fiat lacks. Stage 2, expansion and debasement. Catalysts hit: wars, pandemics, promises, and governments print instead of taxing. U.S. deficits normalized in the 80s, bailouts in 2008, $700 billion, then trillions in 2020. Now in 2026, post-COVID stimulus has added $10 trillion more. It looks prosperous. Stocks boom, real estate surges, but it's paper illusion. They're debasing the dollar's influence by ditching it. Their intra-block trade hit $8 trillion in 2025. 60% in local currencies or gold tokens, starving the U.S. of demand for its debt. Engaging analysis. Zoom into oil markets, where the dollar's petrodollar throne is cracking. Saudi Arabia, now in BRICS, accepted yuan for oil sales worth $50 billion last year. Shocking, right? That's 20% of their exports bypassing dollars. If this scales, the U.S. loses the exorbitant privilege where we print dollars and the world holds them. Result? Imported inflation. Energy costs up 15% year over year, feeding into everything from gas, $4.50 per gallon on average, to freight, up 22%. Market concern: if BRICS tokens become the go-to for commodities, dollar velocity spikes, potentially adding 5 to 7% to US CPI by 2027 per IMF projections. Stage 3. Loss of control. Headlines lie. Assets inflate while life squeezes. US households' credit card debt topped $1.2 trillion in Q4 2025. Delinquencies at 8%, highest since 2011. Governments patch with controls, nudging banks to buy treasuries, redefining inflation. Official CPI excludes volatile food energy, but real costs bite. BRICS accelerates this. Their gold reserves grew 15% last year, now over 10,000 tons combined, while US gold sits stagnant at 8,133 tons. Insiders move. Billionaires like Elon Musk and Ray Dalio have doubled gold holdings, rotating from dollar assets. Shocking alert. In January 2026, China dumped $200 billion in US treasuries, the largest monthly sell-off ever, pressuring yields up 0.5%. If BRICS follows, we could see a bond market rout wiping $5 trillion from global wealth. Deep market analysis. Look at the yield curve, inverted for 18 months, signaling recession. Stocks are propped by AI hype. Nvidia up 300% since 2023, but PE ratios at 28x earnings scream bubble. Gold-backed tokens offer 2 to 3% yields with zero counterparty risk, drawing $300 billion from emerging markets away from T-bills. Stage 4. Endgame. Currency or credit crisis, hyperinflation or freeze. Middle class suffers most. Post-crash, new order emerges. BRICS could lead with a multipolar system, their tokens backing 30% of global trade by 2030. Now, Rome, started with trusted silver denarius, then debased by 90% over centuries. Coins from 100% silver to 5%. Prices soared 20x, edicts failed, economy hollowed. Parallel? Dollar's purchasing power down 97% since 1913. BRICS tokens mimic Rome's early hard money. Weimar, post-WWI, printed marks exploded. Prices doubled every 3 days in 1923, wiping savings. Time preference collapsed. Spend now or lose. 2026 Echo, US M2 money supply up 40% since 2020. If BRICS drains dollar demand, we could see 20% inflation spikes. Venezuela, oil-rich, but printed bolivar into oblivion. Inflation hit 1,000,000% in 2018. Professionals fled. Society fractured. Today, with $150 billion debt defaulted, it's a warning. U.S. risk? Entitlements like Social Security face $75 trillion unfunded liabilities. Dilution could cut benefits 25% in real terms. Why 127 million exposed? That's half the adult population in buckets. Cash holders, inflation fuel, fixed promise reliant, math victims, leveraged fragile, first to fall. BRICS tokens amplify. If dollar loses 20% value, retirements shrink 15 to 25%. Governments escape via dilution. US has done it subtly, but BRICS forces acceleration. Timing? Not tomorrow, but direction clear. Watch for emergency measures, narrative gaps, exit limits. Strategy: layer resilience, liquidity buffer, hard assets, gold up 500% long-term, skill diversification, rotate from paper to control, gold, silver, productive biz. Audit exposure, shift 5% this month. Drop comments. Your concern? One move made? Share successes. I need you to lock in, completely lock in, for this breakdown. Because China's ongoing dump of US treasuries isn't just a headline. It's a seismic shift that's already rippling through global markets in 2026. As Comex Insight, at Comex Insight, you're dialed into commodities and metals. So I'll tie this straight to the gold rush and de-dollarization trends you're likely tracking. We're talking big numbers here. China has slashed its U.S. Treasury holdings by nearly 50% since 2013, dropping from a peak of $1.2 trillion to around $600 to $700 billion as of late 2025 data, with fresh reports in February 2026 showing regulators urging state banks to curb exposure even further due to concentration risk and market volatility. This isn't a fire sale yet, but it's accelerating a trend where Beijing is pivoting hard to gold and alternatives, with China's share of total U.S. Treasuries plummeting to 7.3%, the lowest since 2001. Shocking alert! In just the first weeks of February 2026, news of China's guidance to banks triggered an immediate market jolt. The US dollar index DXY slid nearly 1% in a single day, while 10-year Treasury yields spiked to around 4.25% before stabilizing slightly higher. That's no small potatoes, with the US national debt now exploding past $38 trillion, up from $34 trillion in 2024. Every 1% rise in yields could add a staggering $380 billion annually to interest payments alone, pushing the total interest burden well over $1.5 trillion, more than the combined budgets for defense, education, and infrastructure. Imagine that. We're already spending more on debt service than on safeguarding the nation or building the future. And China's moves are like pouring gasoline on the fire. Let's deep dive the impacts with some engaging analysis, breaking it down into key areas for clarity on the ripple effects, pulling from real-time market reactions and historical patterns. In bond yields and borrowing costs, yields edged up modestly, 10-year from about 4% to 4.25%, as markets absorbed the news without panic. Private investors and domestic buyers filled the gap quickly, with no full-blown sell-off yet, but volatility spiked. Long-term, if China accelerates dumping, for example, via third-party custodians like Belgium or Luxembourg, yields could surge 50 to 57 basis points on average, making U.S. debt auctions tougher and hiking mortgage rates, car loans, and corporate borrowing, feeding into a vicious cycle where higher rates slow growth, widen deficits, and force more borrowing, with the shock being that a mass liquidation could depress Treasury prices by 10 to 15%, adding $500 to $700 billion to annual U.S. interest costs, enough to fund universal health care or wipe out student debt overnight. But instead, it's just more red ink. For U.S. dollar strength, immediate weakening saw DXY drop about 1% on the February news, signaling reduced foreign demand for dollar assets. But it's rebounding as other factors, like Fed policy, dominate, while long-term it erodes the dollar's reserve status, with BRICS nations, including China, pushing gold-backed tokens and non-dollar trade, potentially leading to a 10 to 20% depreciation over 2 to 3 years, boosting U.S. exports but inflating import costs. Think higher oil and consumer goods. And the alert is that China's dump has already contributed to a 47% collapse from peak exposure, with $640 billion offloaded in recent years. Pair this with global central banks hoarding 1,200 tons of gold in 2025, and the dollar's share in reserve could dip below 50% by 2030. In U.S. economy and growth, effects are muted so far. Stocks, S&P 500 dipped 0.5 to 1% initially but recovered, as the Sell America narrative fizzled with strong private demand. With no recession trigger yet, but long-term higher yields could crimp investment and consumer spending, shaving 0.5 to 1% off GDP growth annually. Though, counterintuitively, a weaker dollar might supercharge manufacturing exports by 15 to 20%, creating jobs in Rust Belt states. And geopolitical risks, e.g. Taiwan tensions, amplify this, potentially turning the dump into weaponization, with the concern being that with U.S. debt to GDP at 130% plus, sustained foreign pullback could force austerity or inflation, echoing 2022's bond rout that wipes $7 trillion from markets. As China's shift to gold, holdings up 15% YoY, signals a multipolar world where U.S. hegemony costs trillions more to maintain. For global markets and commodities, gold prices surged 2 to 3% on the news, hitting new highs above $2,800 ounce as safe haven demand spikes, with emerging markets wobbling from dollar volatility. And long-term, it accelerates de-dollarization as BRICS trade in non-dollars up 85% since 2024. Rerouting $5 trillion in annual flows away from USD, meaning for commodities like gold and oil, higher prices in dollar terms. Gold could hit $3,500 if trends hold, with the shocking fact that India and China alone dumped $300 billion in treasuries last year to buy gold, fueling a global gold rush that's pushed reserves to record 10,000 plus tons for BRICS, directly challenging the petrodollar and risking 20% energy inflation for U.S. consumers. Market concern is real, but not apocalyptic yet, as the U.S. Treasury market is deep, 30 trillion plus, and China's moves are gradual to avoid self-harm. A rapid dump would tank their remaining holdings' value and strengthen the yuan, hurting exports, with economists noting this bolsters China's security amid U.S.-China tensions. But it hasn't sparked calamity because other buyers, Japan, Europe, U.S. pensions step up. Still, in a world of 42 trillion U.S. debt, latest estimates push it to 38 to 40 terabytes, but climbing fast. This erodes the exorbitant privilege where America prints dollars and the world absorbs them. And if BRICS fully weaponizes this, say in response to tariffs or sanctions, expect yields to spike violently, adding fuel to inflation that's already hovering at 4 to 5% officially, but feeling like 8 to 10% in real life. Interesting twist for commodity watchers like you. This dump is supercharging gold as an alternative reserve, with China's gold buys up and central banks globally adding 1,200 tons in 2025, 70% by BRICS, as it's not just hedging but strategic, reducing reliance on a volatile dollar system. And if you're stacking or trading COMEX futures, this could mean sustained upside for precious metals amid dollar weakness.